It was an ugly end to an ugly quarter here today as the S&P 500 fell over 1.2%, with much of that occurring in just the last half an hour to an hour. We really kind of cascaded into the lows. In tonight's video, I'll actually show you that the S&P 500 had a little bit of a rarity in the form of its momentum number being exactly zero because we closed at the lows here today. So that was kind of interesting on the market forecast technical indicator. We also have a bunch of bullish intermediate confirmation signals that I want to point out. I want to identify just how bad things have been here recently for newer investors and put that into context, because this was actually the fourth worst quarter that we've had in the last 10 years. And while the last month or so has been a nice rally, it's been a struggle since the beginning of the year. So we'll take a look at that, and then we'll get into our trade application example. On days like this where we're falling sharply, I like to kind of be brave and sell puts into those moves on higher quality dividend growth stocks. So today I've got a consumer discretionary company I wanted to bring to your attention that could result in you having an initial dividend yield of 5% on this well-known consumer-oriented discretionary stock. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 31st, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Also remember, at the bottom of those emails, you'll find the stocks in the S&P 500 giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. If you're not doing so already, I would encourage you to follow me. We also really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity, and let's get started here with our heat map as we usually do. And boy, oh boy, what a difference a couple days make. On Tuesday, we were talking about how nice and green everything was. Today is completely opposite. In fact, this is one of the more one-sided days that we've had in quite some time. It wasn't particularly bad in kind of the first half of the day and in the middle of the day, but really in the last half an hour or so, the market really started dumping pretty hard, and some of those fringe players that were barely keeping their head in positive territory finally got broken down a little bit and closed in the red there. So we had very few green stocks by the end of the day. You can see Intuit is one of the bigger green squares that managed to survive the day. It was up about 1.88% today. A couple of these biotech stocks over here, Regeneron and Vertex, both up about 1 or 2% there as well. Edwards Life Sciences joins them from the healthcare area. We did have Altria, actually a stock that we reviewed yesterday in my swing trading class for a bullish swing trading candidate there yesterday. It continued its way on up here today a little bit there. Kroger was up a little bit here as well, nearly 2% there for Kroger. We had Booking Holdings, so that's a big travel company behind Priceline.com. It was up about 1% today. We had Motorola up not quite 1%, and then Enphase and Solar Edge, so a little bit of a solar theme going on there that kind of managed to break through into positive territory. But for the most part, it was pretty ugly out there. You can see that there wasn't really any rhyme or reason to the bullishness. Sometimes we get a sense that one particular sector is holding up better than others, but that really wasn't even the case today. We've seen a lot of days where, let's say, oil companies have outperformed, but even that, you can see today, they were on the downside, as we did hear some news here overnight last night that they were going to tap into one of the petroleum reserves there, and that would maybe take some pressure off of the prices in the short term. Not sure what that'll do, if anything, longer term, but in the short term at least had oil prices a bit lower here today in reaction to that news. Not even the defense contractors were up, so there's your Raytheon and your Lockheed Martin and some of those that have been doing a little bit better. They didn't manage to go up either. I do see that the agriculture stocks kind of went up a little bit. I see Archer Daniels Midland as an example there, and then Bunge was another stock that we covered yesterday in the factor-based swing trading classes, one of its chief competitors. So a few of those agriculture plays still kind of hanging in there, but That's about it. Everything else pretty ugly. You see some of the brighter reds here in the middle where we have kind of some of those financials. So you saw that Bank of America was down 4% today. Schwab was down 5% today. Morgan Stanley down 3% today. JP Morgan down 3% today. There's Wells Fargo down 3%. Speaking of that, some of you that listened to my presentation on Tuesday might have heard me say that my honorable mention for those of you that wanted to take a bearish trade, so the official trade idea that I gave you on Tuesday was a bullish trade on T-Mobile, and that stock has actually gone up, surprisingly enough, since then. But I said that if I had to take another trade where I was kind of debating back and forth, it was going to be a short selling trade on Wells Fargo. So I said that some of you that want to take a bearish trade might be interested in that one, and I got a kick out of it because I found out that yesterday afternoon when David did his presentation, he actually did a bearish trade on Wells Fargo. So I always like it when I'm in agreement there with David. Of course, he's the master when it comes to technical analysis, and so I was happy to see I was on his side of the equation there. But had you been listening to either me on Tuesday or David last night, you've got a smile on your face today as Wells Fargo did fall another 3% here today. So financials all of a sudden look a little bit wobbly compared to where they were earlier in the year. All right, let's go ahead and pop on over here to the main part of the platform. Remember, whenever we have more than actually, before we get to the chart, let me also show you here from a breadth perspective on the Market Watch tab under Visualize. I've got the S&P 500 pulled up here, and you can see that there were only 69 stocks in the S&P 500 that managed to close in the green today. So that's only like 13 or 14% of the index managed to close in the green. So it was an overwhelmingly bearish day, and again, a lot of it was as a result of the just careening into the close. It wasn't all that bad earlier in the session, and then all of a sudden at the end of the day, things really started to fall apart there. But over here on the charts, a lot of times whenever we have at least a 1% move, either up or down, I like to show you guys this chart, 6D right here. And this chart is basically going to show us, in a different visual form, how aggressively bullish or bearish we are at any given moment in time. Usually the way that I show this to you is on a 1-year daily candle chart. I decided to shake things up here knowing that today was the final day of the quarter, right? Today is March 31st, and tomorrow is April Fool's Day, so don't let David fool you tomorrow in the video like he did here a few years back. But anyway, today is a final day of what has been a pretty ugly quarter, all things considered. To put it into perspective, I've pulled up a 10-year quarterly frequency chart here, and you'll see that this red bar basically will show us how much we were down this particular quarter, which is basically 5%, just a hair shy of 5%, down 4.95% on the year thus far, and also that is the first quarter return. Now, you'll see here that in the past 10 years, we've actually only had 3 other quarters that were worse than this. So if it's felt uncomfortable to some of you, especially those of you that might be newer traders in the last few months, you have a right to feel a little bit uncomfortable because this has not been normal type of behavior. You'll see that the only other 3 quarters in the last decade that have been worse than the one that we just experienced was, of course, the COVID crisis quarter, which would have been right over here, the first quarter of 2020. That quarter, we were down 20%, actually. How about that? Right on the dot from the beginning of the year to March 31st in 2020, we were down exactly 20%. You can see here on this quarter back in, I guess it would have been kind of the winter of 2018. I think if my memory serves me correctly, that was when we had that Christmas crisis. Some of you recall that we actually had really terrible trading during the holidays that particular year, and usually it's the exact opposite. So we ended the quarter near a low there as we closed out the year 2018. In that quarter, we were down about 14%. And then there was this quarter back here way back in 2015. Some of you probably don't even really remember it. I don't remember it particularly other than the flash crash that took place. Some of you have seen me share my screenshot of some of the trades we were doing in my classes that day, and we got some incredible fill prices on some stocks that we had been waiting for at lower prices. So that was that flash crash moment in August of 2015, but would have eventually closed even lower than that. Heading into, I guess, September would have been the quarter close there. So other than those 3 moments in time, what we just experienced was literally the 4th worst quarter in the last entire decade. And again, especially for those of you that might be newer to the markets, this has probably felt uncomfortable. Take a look at all of the quarters since this terrible quarter exactly 2 years ago. We've had nothing but upside. 1, 2, 3, 4, 5, barely see that one, 6, 7 quarters in a row with positive gains bookmarked by the first quarter of 2020 and the first quarter of now 2022. So had you started investing at any time in the 2 years since the coronavirus low, this is effectively your first negative quarter that you personally have ever experienced. I've been at this game a while now. I first started getting interested in investing back in the late 90s and trading all the way back in 2000 and all that when the dot-com bubble was going on. And so I've seen a few of these along the way, and therefore each one that you survive, I can assure you, you feel better about the next. It doesn't mean that it feels good. It just means that you've been there, you've done that. You're able to kind of keep a cool head about your shoulders and look for opportunities when they emerge. So if you are new, that's, I guess, my pep talk for you. Stick with it. I know it's been a little bit more difficult here in recent months, but this too shall pass. Better times are on the horizon. It is my belief that stocks eventually do go higher over the long term, but we do have to earn our keep as investors, and the price that we have to pay, the admission to get into the game, so to speak, is the risk that we take of losses along the way. And I think a lot of you do a really good job with that. But if you are new, be aware that if you felt uncomfortable here in the last 3 months, it's okay. You have a right to feel uncomfortable given what we just went through from a historical context there. Maybe we can shake this up as well, since it's also the end of the month, of course, in addition to the end of the quarter. Maybe I could change this from a 10-year quarterly to, let's do a 5-year monthly and kind of get a sense of that as well, because that changes the picture a little bit. One thing that's maybe been lost in it a little bit, especially since we ended the quarter on such a sour note here today, is the fact that we've had a heck of a rally here in the month of March. You can see that despite today's losses, we still ended up having a very strong month. We were up 3.57% for this past month. So all of the 5% losses that I was just talking to you about a moment ago about the quarter were as a result of the 2 starting months of the year. January and February were particularly bad. January was down 5.25%, and then February was down 3.13%. So with us being up 3.5%, in a way, you kind of had March take away February's losses, but we're still left with January's losses after we settle all of that out. So you can see again that more times than not, had you been investing in the last 5 years, you have a lot more green bars here than red bars, meaning that you've had a lot more positive months than negative months. And remember, you can't go through the world of investing with just somehow avoiding those months of losses unless you have a crystal ball, which I can assure you I personally do not have. So it is part of the game. You just have to learn how to deal with it. Even from a yearly perspective, we've been very, very blessed. If we were to come back over here now and take a look at, let's say, a 20-year and then the frequency or aggregate period, let's do a year instead in this case, you can see that we've been blessed for the last 2 decades, really, nicely to the upside for the most part. As you look back at all of these 20 bars that you see in front of you, you only have 4 red bars. This, more devastating one, naturally, back in 2008, that of course was the great financial crisis, kind of our our generation's version of the dirty 30s, I guess you could say, where that particular year we were down 38%. But then you'd have to come, this one was basically a flat year right here in 2011. It was basically flat if you were to include those dividends. This year was down a little bit more over here in 2015, but not a big deal at all. It wasn't even down a full percent. You can kind of see, I know it's going to be hard for you, but right where I'm circling right there, that's where if you point at the candle, it'll give you that information. So if you glance back up there now, it says minus 0.726602. So in other words, that year was also a pretty flat year where you didn't even give up 1% that year. This year was a little, or this particular year that I'm circling here was a little bit more aggressive. That was that 2018 that I'd mentioned where the holiday season was a little bit uglier. And so we ended the year poorly. That year, the market was down about 6.23%. And then that takes us to where we're at right now. Now, obviously, we've only completed 1 quarter out of 4 thus far this year. And there's no guarantee that this stays red, right? If we were to rally from here until December 31st, this particular bar right here could very well start growing and turn green by the end of the year. But right now, if we were to end the year right now, this would be the 3rd worst year that we've had in the last 20 years. So again, that's saying something. And normally throughout history, you get approximately 1 down year in every 3. In other words, you've got kind of 2 steps forward, 1 step back. You've got 2 years that are positive, and then 1 year that is negative in the typical 3-year period throughout history. So again, we've been kind of blessed in the last 20 years here because I think the ratio kind of bends or leans towards the bulls more than towards the bears in this last 2-decade period that we've mostly been trading through together. So, we should count our blessings. Yes, this has been a difficult year. This has been a little bit harder for some people to come to terms with. But the truth of the matter is the markets have blessed us with many gains along the way, whether you're looking at quarters or months or in this case, years. And so it's important for you to gain that historical context and understand that, as I mentioned before, this too shall pass. Brighter days will eventually be on the horizon. Whether we've got more work to do on the downside during 2022 remains to be seen, but I do take that leap of faith as a long-term investor that 10 years from right now, the markets will be higher than where they are at right now. And therefore, I'm always on the lookout for opportunities when I can spot them. Let's go ahead and take a look here now at the 1-year daily version, just to show you real quick that this red line did cross down below this blue horizontal line that represents the 1% lower move. Remember when I was with you on Tuesday, we had this green line up above the blue line, and that would have been a 1% plus move. This is a 1% minus move that we experienced today, 1.57% to be exact. Now remember that the VIX typically goes up when markets go down. And you can see here that there's a little bending higher in this purple line down below that represents the VIX. When I was with you on Tuesday, I believe we were just a hair below 20 at that time. So we're back above 21 here with the last 2 days worth of selling. That's kind of what that looks like up there. I would also point out that it looked a little bit more promising on Tuesday when it looked like we were breaking out above that slight double top right there. This is not a good way to confirm that. The last 2 days we've fallen in the market, and thus it sets up the possibility that was a head fake. So it can stabilize here as well. So we don't want to necessarily write the eulogy, but it's not a good look there. Usually when you have a breakout, you want to see a continuation move beyond that. This one was tough because they chewed up so much positive energy off the bottom that by the time they got to the breakout area, the market might have been a bit exhausted. So if this market does roll over, and let's say it gets down here to, 4,400 or 4,300, and then it stabilizes there and it looks like it's going to go up again, I think that would actually be a positive aspect for the market. I know it wouldn't be fun to get down to those levels because it would require some losses from here, but I think it would be healthy because that was too strong of a burst that we just experienced there. And again, Like I mentioned on Tuesday, a lot of that was as a result of Apple being up, 11 days in a row or whatever it was. And so if we can kind of cool off a little bit here and then stabilize at a higher low, somewhere around 4,300 or 4,400, and retain these prior lows over here and not breach those lows from around 4,200, I think that actually is something that you can build upon going into the summer. So let's see if that's a possibility there moving forward. Let's go ahead and take a look at our 4-grid here. And this is chart 4B for those of you that are the premium market scholars following along at home. And as you can see, we do remain with our strongly bullish postures across the board, as was the case on Tuesday. Now, we talked about on Tuesday how the Russell 2000 had an overbought cluster signal there. So it's interesting, in the 2 days since then, we've basically eliminated that candle. And now we're right back to exactly where this thing was flatlining for the week prior to that. But you will notice that where things kind of settled in today, we technically have what's known as a bullish intermediate confirmation signal right here on the Russell 2000. The problem is we wouldn't consider it ideal. There's a couple different ways that we try to determine that. First of all, for those of you that are not familiar with that term, since we have been more bearish here recently, some of you that just started watching these videos in recent months might not have heard the term bullish intermediate market or bullish intermediate confirmation signal before. What we're referring to with that is effectively a buy the dip signal. What we're looking for is the green line to be considered bullish. Right now it's in the upper reversal zone, so it's automatically considered bullish. At the same time, the red line is in the lower reversal zone, which, as you can see, is way down there right now. So those two things basically confirm that this is an actual bullish intermediate confirmation signal. Obviously, you had your dip. You have a intermediate trend that is establishing itself to the upside. So people who are waiting for a pullback, well, you just got one. If you didn't like buying it there with the overbought cluster signal, you probably like the price is a lot better here 2 days later. But why I had mentioned before this isn't an ideal one is because the red line is so low. Notice that the momentum line here in the label, the reading is 1.02 and falling. Remember, this does not go below 0. So in other words, this is about as low as you could possibly get. So we do look at that idea of having too much extreme push to the downside. So usually when the red line is below 5, we're a little bit more hesitant towards that. So we need the red line to be below 20 in order to have the signal. But if it's between 20 and 5, we feel a little bit more comfortable with that. If it falls so far that it goes even below 5, then there's a possibility that the short-term negative momentum could start dragging the other lines down with it. So that would be one of the concerns. In fact, that is the concern across the board. In fact, this is a rare example over here on the S&P 500. Notice in the red label there, 0.00. It is literally at the low. You cannot go lower than that on the red line. And that's because in the short term, we had a pretty big range day today, and we are at the exact bottom of the range. So this basically tells you, when you see something like this, that you closed on the lows. That's pretty much the only way that that red line can have a 0 reading. And that is exactly what happened here today on the S&P 500. 45.30 spot 41 was the exact low price of the entire day. And that's not a really good sign for the most part, right? It basically gives you the impression that if the market was cascading with selling into the close, that had the market been open in another hour, it probably would have fallen even further. The momentum would have taken it down. So not a great sign as we kick things off tomorrow. Now remember, tomorrow is the first day of the month, so I think the bulls have that going in their favor. Remember, if you were to look at stock market statistics, especially from Stock Trader's Almanac, I have a copy of mine right here as a desk calendar. They will tell you in there, they go back throughout history and they record the best and worst days, and they add up all those statistics. And what they've found is that the best stock trading day, if you were just kind of break it down by the days of the month, is the first day of the month. Go figure. And it's not even particularly close. In fact, there is a staggering amount of gains throughout history that is the direct result of the first trading day of the month. Now, obviously, you can't take a statistic like that and bet the farm on it, because there will be months where the first day is down, so it's not anything close to a guarantee. But if you're playing the odds throughout history, it does suggest that the first trading day of the month is typically a bullish day. In fact, as I look at the Stock Trader's Almanac in front of me right now, it's got the little bull icon on it. You guys can't see this because it's on my desk, but it says the first trading day in April, the Dow and the S&P 500 have been up 19 out of the last 27 years. And so not only is April itself, from a monthly perspective, one of the stronger months during the year for the stock market, but the first day of April tends to be a bullish one. So maybe that will help bail us out tomorrow. In addition to that, since tomorrow is the first Friday of the month, if I'm not mistaken, I think the big jobs number comes out tomorrow as well. So that could have an impact on trading early on in the pre-market session as well. So keep your eye on that possibility there. But all of these four charts that we see in front of us do have those bullish intermediate confirmation signals. The problem is all of them have their red lines below 5. You've got S&P 500 at 0, as I mentioned before. Dow Jones barely off of 0, 0.04. NASDAQ Composite barely off of 0 too. It's 0.51. And then, as I mentioned before, Russell 2000 1.02. So these are extreme moves across the board, and we basically closed on the lows of the session on all of these. So that kind of calls into question the validity of the bullish intermediate confirmation signal, all else being equal. The other thing that we like to look for in those signals is where the blue line is positioned. And I think that's kind of the positive news of this situation, because as you can see, if you were to read the blue lines in each of those four charts, with the S&P 500, it's at 35. With the Dow Jones, it's at 41. With the NASDAQ Composite, at 31. And with the Russell 2000, it's at 24. Where we like to see those blue lines positioned on the day that we get the bullish intermediate confirmation signals, we'd like to see those blue near-term lines somewhere between 50 and 20. So from that perspective, that's the good news. We do have that particular line positioned where we'd like it. The problem is the red line and how aggressively bearish it got right at the end of the day. And so it does offer up maybe just a little bit of hesitation there. I would also mention that after today's moves, we had a couple changes in the 30-day moving average lines. Notice on the Dow Jones, the moving average line itself went from green to yellow. You saw the same thing down here with the Russell 2000, green to yellow. And what it means in that particular case is that price is obviously still above the moving averages, but the moving averages have started falling again. Because remember, the moving averages, just like almost all technical indicators, are going to be backward looking, right? They take inputs from the past and then they put them together and form a line in this case. And just because we've had a couple of more bearish selling days the last couple days, there's been enough of an impact there where it's actually bent those lines lower. With the S&P 500 and the NASDAQ Composite, we haven't seen that yet, but I think even with my naked eye, I can see right here that we have flatlined exactly almost sideways there on the S&P 500 and the NASDAQ. So in other words, if tomorrow is another big selling day, wouldn't be surprised in the least if the color changes take place on the NASDAQ and on the S&P 500 as well. Whereas if it's a big up day, then maybe they'll be saved by the bell. And we would have the possibility of these yellows moving back to green on the Dow and the Russell 2000. So tomorrow could be potentially a pretty big day there as we head into the Final Four weekend with some of the best blue blood teams in college basketball. So for all of you Kansas and Villanova and North Carolina and Duke fans out there, all the best to your teams. I'm very much looking forward to witnessing, hopefully, some excellent games. And of course, with Coach K having his final season. Maybe there'll be some magic left there with the Blue Devils as well. So should be a great weekend. But up until then, we've got one more day of trading here in the markets. So to put a ribbon on it, S&P 500 was down 1.57% today. Dow Jones was down 1.56% today. NASDAQ was down 1.54% today, and the Russell 2000 was actually the day's leader, believe it or not, by being down only 1% exactly. And all of them continue to have strongly bullish postures, and we do have bullish intermediate confirmation signals on all four of them, and 2 of the 4 charts continue to have a green 30-day moving average, meaning price is still above a rising moving average. All right, let's go ahead and step away here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. 110 of you clicked like for me the last time I did the video there on Tuesday. And as I always say, as long as we're getting at least 100 people to take 5 seconds out of their day to click like for us there, that I'm more than happy to do a full-length video, including a trade application example the next time I'm scheduled to do the video. So if we're under 100, then maybe we would just do a quick little 15-minute quick hitter video. So depends upon what you're hoping to get out of them. If you just want a quick little recap, then don't click like. But if you do prefer these longer format versions where you get maybe a little bit more details out of it, then we would encourage you to click like there for us on Twitter, as it is one of the things that motivates us to try to not only educate you guys, of course, but also to get the word out about our business. And that's one of the best ways that we can do so through social media. So we don't get paid to do these videos here on YouTube, but we do hope to at least establish a presence of hopefully good content for you guys to sink your teeth into regularly. So thank you very much to all 110 of you that clicked like for me the last time around. Also earlier today, we taught our typical classes. So David taught his ETFs class, and then I taught my question and answer session. Those are posted to the website, so feel free to check those recordings out if you're a premium member. Also, David just got done putting together the April class calendar, so you can see under the popular recent posts over here, the Trading Room's registration, and again, that's something that's available exclusively to our premium members that allows them to basically register for all of our classes for the month of April with just a couple of clicks, as opposed to having to register for every single class along the way, which is a little bit more cumbersome. So make sure you're taking advantage of that. And David should have sent all of you premium members an email here to remind you of that process just a moment ago. On our Q&A class here earlier today, we had some great questions, as we always do. Had a question about what happens when a stock does a reverse split and what do we do from a dividend growth investing perspective. We also looked at Cogent Communications as a dividend growth investing prospect. We talked about Walgreens after they disappointed with their earnings announcement earlier today. We talked about some of the scans and the lack of scan capabilities in some cases with paper money versus what is capable on a real money platform. Also talked about European heavy construction companies other than Kubota or Caterpillar if Ukraine eventually needs to get rebuilt. So we went through a number of machinery companies, some of them foreign, that might catch your interest in that particular question. And then we also had a question about AT&T and the Warner Media split that's going to be happening here next month. So if you have an interest in those questions, feel free to check out that recording. Also, let's talk about our factor selector tool here briefly. You can see that dividend yield once again stayed up at the top. They've been up there for about 9 or 10 weeks in a row, as they have been kind of the stalwarts of the market. They haven't probably been rallying as strongly as some of the other areas in the last 2 or 3 weeks, but leading up until that last 2 or 3 weeks, they had retained their value and their gains much better as the market became concerned with growth stocks. They started hunkering down in those kind of cash flowing blue chip types of companies from the dividend yield factor. We did find that quality for the second straight week stayed at the bottom. And remember, quality these days is made up mostly of technology stocks. So if technology stocks are out of favor, unfortunately, that typically means that quality from a factor perspective is out of favor there as well. And then I also wanted to point out that low volatility had a heck of a move higher here week over week. We talked about that a little bit on Tuesday's video. Remember when I was telling you about real estate and utilities utilities really making a strong move on that particular day, and I think that had the ability to impact the low volatility stocks in general when REITs and utilities start stabilizing a little bit more. All right, let's get back on over to the charts and do some 12 grid analysis now, starting with chart 5A. This is our asset class 12 grid, and the background colors will be green if we have bullish intermediate postures. The background colors will be pink if we have bearish intermediate postures. One thing that's a little bit surprising as I look at this, my attention has been drawn to the bottom rung on chart 5A for the last few months, as I'm sure you guys have noticed if you've kind of seen my routine. But what's different about it this time is 3 out of those bottom 4 actually have pink background colors here all of a sudden. When I look at the charts all by themselves, I don't necessarily look at them and think, boy, these charts are really breaking down, but there's been enough wear and tear in the short term where there has been a slight posture shift. So we want to at least respect the fact that the technical indicator is telling us that information, even if we don't necessarily feel compelled to trade that way. In other words, I'm probably not going to go out of my way to short gold or oil at this moment in time, despite the posture, but it is at least something that I can tip my hat towards and say that I offer up my respect towards and just kind of have more of a hands-off approach towards those, right? You don't necessarily have to be bearish on them if they have a bearish posture, but if you otherwise would have been bullish, by not taking a bullish trade, there is an embedded bearish element within that by basically doing nothing and staying in cash a little bit longer while you kind of figure the trends out a little bit. So I do find that a little bit interesting. With oil, as I mentioned before, it was very much news-driven today as a result of what President Biden was mentioning with tapping into the strategic petroleum reserves and things like that. So that pressured oil prices there. So that makes a lot of sense. But we do still stay right above that rising 30-day moving average there. Gold actually was up today, but not by much. It was just barely above break-even. It was up 0.04%, but it too is also just sitting on that rising 30-day moving average, or in this case, it's just a hair below it. That's why the moving average is yellow in that particular case there. But both gold and oil, I think, are positioned right now where they could easily find a bounce from this moment under the right set of news stories. And then the dollar as well. Dollar was up. US dollar was up 0.42% if you're using UUP here, which is basically the dollar versus a basket of other foreign currencies. And you had a nice bounce there. So I kind of like the way that the dollar looks right here. That's a good bounce up and off of that moving average. So all of those charts have pink background colors, but none of them am I actually sold to take bearish trades on. If anything, I'd probably prefer to be on the bullish side of the equation at this exact moment in time. But of course, things will change. That's the beauty of looking at these charts every single day. If we start breaking more obviously below the moving averages, then I'm going to start singing a slightly different tune. But right now, I kind of want to give them the benefit of the doubt. They've been strong charts for the last 3 months, and while they've sold off here in the last week or so, I wouldn't necessarily count them out for a further move higher in coming weeks and months. So we'll keep a look on that here together. All the way off to the right-hand side, we do see that TNX fell for, I guess it's its 4th straight day. So remember, this tracks the 10-year Treasury yield. You move that decimal point over to the left once. That means that on the 10-year U.S. government bond, you're going to get paid about 2.32% per year for the government to borrow money from you. For some of you, maybe that's a good trade-off. For me, I'm not particularly enticed by that. But then again, I'm not in my retirement years either, so there is that aspect of safety of capital and preservation and things like that you need to consider as well. But without a doubt, we can see here that interest rates have gone higher up until the last 4 days, and we kind of topped out there on the 25th and now have pulled back pretty considerably. We're back now to the levels of where we closed the session back on March 21st. So this last little oomph move right here has been completely unwound, but we remain way above that rising moving average. So until we start breaking down below the moving average, I'm going to make the assumption that the path of least resistance for interest rates continues to be to the upside. Now, with interest rates down today, naturally, bond prices themselves were up. So TLT was up 0.24%. You can see it having a little bit of a reflex type of a move here, but we still remain below that falling moving average. So again, similar conversation, just kind of mirror image. I'm going to assume that TLT will stay in a downtrend until proven otherwise. Right now, I don't have any reason to believe that's not the case, but if it breaks above this moving average and stays above it at least longer than it was able to back here, then maybe, just maybe, we can get a legitimate trend reversal. But I'm personally not holding my breath right now. Bitcoin suffered today. You can see it was down about 3 or 4%. We closed Bitcoin at about 46,000. So it touched 48,000 a couple of days ago at its highest point when it put this overbought cluster signal in place here with this red dot. But I still kind of like the fact that we are above the rising 30-day moving average. And I like the fact that we still have a strongly bullish intermediate posture with that dark green background color there. Remember, Bitcoin is a risk asset, right? It's not a safety asset, at least in my mind, and it trades like a risk asset. So when tech stocks got blitzed today, it wasn't a surprise that Bitcoin also got blitzed. If tech stocks can reverse tomorrow, then I would venture to bet that Bitcoin would probably go up with tech stocks tomorrow as well. So, you're kind of beholden to the risk trade to a degree, but I am happy to report that there's been legitimate progress in this chart here. And so I think that is helpful. On the top rung of charts, you will notice that we do have our EFA and our EEM both falling today. And as I was mentioning on Tuesday, EEM looks a little bit worse to me than EFA. And this is kind of part of the reason behind that, right? With EFA, we were well above the moving average. So that gives us the freedom to have a couple sell-off days without kind of immediately thinking that the trend is ruined. With EEM, we don't have that luxury. We barely got above the moving average at the height of this reflex rally that we've all been experiencing in the last 2 or 3 weeks. And so that means when we do have a more aggressive sell-off day like we did here today, that all of a sudden your first thought is, here we go again. This is another bearish looking chart. So, maybe for those of you that are bold enough, if you are looking for bearish charts out there on a day like today, maybe selling a bear call spread or doing something bearish to either EEM or the emerging markets individual stocks could be an opportunity there for you. Did want to point out preferred stocks as well. Mentioned these guys on Tuesday, and unlike a lot of the other assets that were up nicely Tuesday, but then have pulled back the last 2 days, preferred stocks have just kept on going, right? So that's kind of a rarity there. Preferred stocks had that nice move right up to the resistance area at the end of February on Tuesday. And then yesterday, Wednesday, and today, Thursday, we are now basically at, I believe, our highest closing price on PFF, which represents preferred stocks, since going all the way back here to this candle back on February 9th. So I was kind of mentioning how that looks like the possibility of a legitimate reversal pattern there. Maybe not a perfect textbook example of an inverted head and shoulders pattern, but you get the gist of it, that's kind of what it appears it wants to do. Whether it will or not is anybody's guess. But I think it is worth sitting up and paying attention to the fact that it was up in the last 2 days when most of the other stocks in the market were down. So, naturally preferred stocks are not the same thing as common stocks, but nonetheless worth noting. So let's keep our eye on that potential reversal there. Let's quickly take a look here at the sector 12 grid as well. This is chart 5C. And as you can see, things look a little bit different than they did on Tuesday. Remember, on Tuesday I was mentioning how we had a clean sweep of nothing but green charts. 2 days later, we've got a couple of pink ones on the board. One of them I'm not surprised by, the other one maybe a little bit more so. The one I'm not surprised by was XLF, because remember, I told you on Tuesday that if there was an exception to all the green charts, I would have pointed out specifically the financials. Again, that was part of the conversation where I was mentioning short selling Wells Fargo. And the reason I was mentioning that is because it continued to have its yellow moving average despite being above that moving average at that time. The moving average itself was still falling. Whereas on Tuesday, all of the other charts had green tips on their moving average. We've now seen communications go back to yellow as well, but on Tuesday it was green there. So I wanted to specifically point out to you guys that I didn't like the look of financials that day, and I also pointed out to you guys on Tuesday how financials candle closed in the lower half of their range. Remember, on Tuesday, most of these charts, these sector charts, closed near their highs. So it was already sticking out to me like a sore thumb with the financials closing in the lower half of their range on such a bullish day. And you can see why that could have been a precursor or a canary in the coal mine, as it were, that this has been an awful sector for the last 2 days since then, including today being down 2.29%. Which, if I'm not mistaken, let me just verify, yep, it was the worst performing sector here today. So let's kind of register that in the back of our minds, even if I'm not there specifically telling you about it. But if you ever see a day like that in the future, where all the charts are closing near the highs, but there's one sector that closes in the lower half of their range, perhaps that's a sector that you can pick on bearishly, and it might not work out exactly as nicely as it did this time around, but perhaps it is an opportunity for you to think a little bit different than you might have otherwise. And then the other one that has a pink chart is energy. It was down 1.36%. That's actually not that bad of a result considering oil prices were down even more than that. So the oil stocks held up better than oil itself. So I guess that's the good news. But the bad news is you can see that we now have a weekly bearish posture here. But of those two, it's like night and day. The energy chart still looks strong, so you could still easily get a bullish trend out of this, little bit of selling that we've had in the short term, whereas that financials chart looks like it just put in its third lower high, and you still have lower lows that you're in contention with there as well. So financials is the one that looks like it's the biggest problem child at this moment in time. In terms of who the best performing sector was today, I guess it would have been utilities. Now, all sectors were lower today, but utilities were lower only by 0.11%. And again, going back to the factor selector, remember utilities are a big component within the low volatility factor. And after witnessing utilities going straight up here for the last week and a half, no surprise that the market is kind of liking some of those lower volatility types of plays once again. Some of you saw me tweeting about here in the last 24 hours, Sempra Energy, a natural gas utility company that I got some kudos on there on Twitter. So thank you, New Low Observer, for mentioning that, as Sempra was a company that we had been buying in our dividend classes about 6 months ago when everybody hated the company, and now has just skyrocketed to all-time highs all of a sudden. So, and there's been a number of natural gas focused utilities that have done the exact same thing. So utilities are kind of back in vogue here all of a sudden once again. All right, let's get into our trade application example. And that will be, I want to use chart 2A for that conversation. And I wish I would have held off until the exact end of the market to place this trade. I didn't know that we were going to dump into the close, so I actually did this about a half an hour before the market closed there, and I wish I would have held off a little bit longer because the market, obviously, as I mentioned before, closed at its own lows, so naturally most stocks were also closing near their own lows. So with Whirlpool, what I did is I sold the 140 put for the month of May. You can see I am down $10 on it already. So had I waited until the close, I could have gotten back those $10, so to speak. But not the end of the world, but just kind of pointing that out because sometimes it goes the other way, right? Sometimes I do the trade a half an hour early and, it immediately swings into our favor. This is an example of the opposite where it doesn't always work the way that you want. And we're already underwater on this trade by $10 as we got filled at 145 and the mark is 155. The May contracts have exactly 50 days until expiration, and the reason I selected that particular strike is it was the one that was closest to a 1% return on risk, this ROR column up here. The 140 strike in May has an ROR currently of 1.12%. That's usually a nice healthy balance between reward and risk if you're thinking like kind of a long-term investor when you're approaching these sold put opportunities. Because remember, the sold put gives you the opportunity to buy a higher quality stock at a lower price if the company continues to fall to those levels. So with Whirlpool here, you can see that the reason I selected it here for our trade example today is we've got this little green dot showing up underneath this bar all of a sudden. What that signifies is that Whirlpool now has sold off aggressively enough that we have what's known as an oversold cluster signal on the weekly candle chart, or in this case it's technically a bar chart, but the same thing. And typically that is an area that is of interest to me as a long-term investor, of where there could be the start of a bottoming process being formed, especially if the stock comes into this blue zone of the dividend stair-step chart, which is where long-term investors also become more interested in the merchandise. You can see that over here on Whirlpool, we had a lot of these green dots showing up. So just because we got one over here doesn't mean we can't have another one next week and the week after that. So it doesn't guarantee this is the bottom or anything like that. But it does give you the impression that the selling is coming closer to an end, or at least that's the hope. And so it might not be a perfect buy right here at 172, but what we did was we sold the 140 strike. And the 140 strike is way down in this area down here. Obviously, this is already a high-yielding company. Its dividend yield on Whirlpool, ticker symbol WHR, is already over 4% at this exact moment in time. If we were forced to take ownership of 100 shares of this at 140 in the middle of May, then our dividend yield would become even greater at the start. You can see that they just recently hiked their dividend dramatically to 175. So if we wanted to annualize that, 1.75 times 4, because there's 4 quarterly payments per year, so they're paying out $7 in the coming year in dividends, divided by 140. Technically, it's a little bit closer to, I guess it would be 138.60, somewhere in that general vicinity. If we got filled at 140. I think we got filled at 145, but you get the gist. It's right around that basic cost basis that we would have right there. Our yield would go up to 5%. So it's already high here at 4% and somewhat attractive for some of you that are looking for this type of a business. But it would become even more attractive if we bought it down here at 140. So that's what we're now on the hook for. If the stock does go from 172 down to 140 or less, we would then have to buy it if it closed at those levels in the middle of May, at which case we would pick it up for a starting yield of over 5% on a company that's raised its dividends for over 10 years in a row. A lot of these housing-related plays have struggled here recently, and Whirlpool itself is kind of caught in a little bit of a tough spot because, of course, they use a lot of metals and different things like that, building their washers and dryers and refrigerators and all that kind of stuff. So they might be a little bit more impacted by rising materials costs and input costs there. So I think that's probably why the market has kind of turned against them more recently. But I think down there at $140 is a pretty attractive level for a long-term investor if you can start your process off with a 5% dividend yield on a company that's as well known as Whirlpool. Okay, so that's our trade application for the day. I hope you got value out of this presentation. Enjoy the Final Four this weekend. I know I will. And if you got value out of this presentation and you want me to do another full-length video the next time I do the video, be sure to take the 5 seconds out of your day to click like for me there on Twitter. David should be back with you tomorrow as well, so make sure you're checking out his excellent analysis, and then I'll look forward to hopefully working with many of you next week. So with that, all the best of success with your trades and your investments. Goodbye for now.